Yeah, Pratishtha, can you just start now?
Residential status. Tax incidence on an assessee depends on his residential status. For instance, whether an income accrued to an individual outside India is taxable in India depends upon the residential status of the individual in India.
Okay, so this we already know it. Okay, fine.
Similarly, whether an income earned by a foreign national in India or outside India is taxable in India depends on the residential status of the individual rather than on his citizenship.
So basically, you know how you're going to pay tax, whether you are earning in India or abroad, whether you are an Indian national or a foreign national. All that law is made on the residential status. That nothing depends upon whether you are a foreign citizen or Indian citizen. So you're going to pay tax depending upon the residential status. In the net, all the resident people who are resident in India, ordinary resident, they have to pay tax on the global income. But that means whatever income they are going to earn, whether in India or abroad, they have to pay tax in India. And the person who is a non-resident, he pays only tax for whatever money he earns in India. Okay, and similarly, a resident but not ordinary resident also, he has to pay tax for only income which is earning in India. Okay, of course, there is one exception which we'll discuss later. So he has to both resident as well as resident but ordinary resident. They are going not to pay any tax for any income which they are earning abroad. Okay, so a non-resident as well as a resident but not ordinary resident, they don't have to pay any tax for whatever money they're earning abroad. Okay, but they have to pay tax for whatever money they're earning in India. So all, whether you are resident, not ordinary resident, or not, ordinary resident or non-resident, you have to still pay tax for whatever money you are earning in India. Okay, so we are going to understand that. Okay, a little bit more deeper.
The determination of the residential status of a person is very significant in order to find out his tax liability.
So this is very important. So we're going to understand. Yeah.
What must one know for deciding residential status? Different taxable entities, an individual, a Hindu undivided family, a firm or an association of persons, a joint stock company, and every other person.
So either you can be individual, or you can be an HUF, or you can be a partnership firm or association of person, or you can be a company, okay, or any other person. So we must know how this residence status are determined. Okay.
Residential status of HUF. The residential status of HUF depends upon the control and management of its affairs.
Okay. Fine. Like I have an HUF. Myself, my wife, my both the children. So it's an HUF. Okay. Fine. And it will depend upon the status will depend upon the control and management of its affairs. From where the control and management taking place. Now, as far as my HUF is concerned, all the control and management lies in from Gurgaon, that is India. Okay.
Resident HUF. If the control and management of the affairs of HUF is situated wholly or partly in India, then HUF is said to be the resident in India.
So that means if my HUF, which is called Pravesh Agi HUF, it is basically all the control is fully, from India, wholly from India. So it's a resident. So my HUF is resident in India. Okay. So whether even, like my daughter who is in England, so if she is participating in, management of the HUF, but still it is partly. Okay. So that means, either wholly or partly in India, the HUF is will be residence in India. Okay.
Non-resident HUF. If the control and management of the affairs of HUF is situated wholly outside India, then HUF is said to be non-resident in India.
Suppose tomorrow I, make a call and I go to England and settle down there forever. So I have an HUF. So since all the decisions are taken from England, so it will become a non-resident HUF in that case. My own HUF, which is Pravesh Agi HUF. Okay. So that HUF will be non-resident if I move to England and and take all decisions of the Hindu undivided family. Decisions are taken outside India since I am living abroad. So it will become a non-resident. Okay.
If the HUF is resident, then the status of the Karta would determine whether the HUF is resident or ordinarily resident or resident but not ordinarily resident.
Now, in case of a HUF also, we have to find whether he is a resident, it's a resident, or an ordinary resident or not ordinary resident.
If the Karta is resident and ordinarily resident, the HUF would be a resident and ordinarily resident, and if the Karta is resident but not ordinarily resident, then the HUF would be a resident but not ordinarily resident.
Now, there is a Karta who is the head of the family. Now, in my case, I'm the head of the family, I'm the Karta. Okay, so I have a HUF where myself, my wife, and my two children. So myself, I'm called the Karta. I sign all the checks, I take all the decisions, and all my bank accounts are operated by the Karta. But now I have got my son and my daughter. They are both co-partners. Okay, as law they call them co-partners. Okay, so they are basically lineal descendants of my family. So I am the Karta. Now, for understanding the residential status of the HUF, now the second thing we look at is the Karta. So if all the like for my HUF, since all the decisions are taken in India, so it's a residential HUF. But then we must look at the status of the Karta. Now I am a Karta. I am also a resident or not normal resident. Okay, not an RONR. So that means the the HUF will be would be resident and ordinary resident. So in my case, I am a HUF which is resident and ordinary resident. Okay, if suppose I would have settled down in England, okay, so I would have become a non-resident. So then even the HUF would be, the status will depend like this. So just read this. Residential status of an HUF is the control and yeah, just read this. Yeah.
Residential status of a HUF is the control and management of its affair situated wholly or partly in India? Yes. Is Karta resident in India at least in any 2 previous years out of 10 previous years preceding the relevant previous year? Plus, is his stay in India for 730 days or more during the 7 previous years preceding the relevant previous years? Yes, HUF is ROR. No, HUF is RNOR. And is the control and management of its affairs situated wholly or partly in India? No, HUF is non-resident.
So that means this is a chart which explains, like suppose the control and management is outside India, okay, then it will be a non-resident HUF. But if the control and management is India, and the answer is yes, then we look at the Karta status. If the Karta is resident and ordinary resident, then the HUF will be ROR. If the Karta is RNOR, then the HUF also becomes RNOR. Though HUF is resident, but the Karta is having a status of RNOR, then the HUF also becomes RNOR. Okay, fine. So meaning of control and management, you can just read. I'm just leaving it. Okay. Just read this question, and we are just doing an example, and then you can ask question because this is an HUF question. Just read this.
All the policy decisions are taken there. Mr. E, the Karta of the HUF, who was born in Kolkata, visits India during the previous year 2023-24 after 15 years. He comes to India on 1st of April 2023 and leaves for Australia on 1st of December 2023. Determine the residential status of Mr. E and the HUF for assessment year 2024-25.
Okay, so there was some break of voice. I'm going to read again. The business of HUF is transacted from Australia, and all the policy decisions are taken there, which means this is a non-resident HUF. Is that because all the decisions are taken from Australia and the control and management exists in Australia? But then we look at basically Mr. E. Now, E is the Karta of the HUF who was born in Kolkata, visits India during the previous year 2023-24 after 15 years. So for the last 15 years, he had never been in India. He just comes last year. He came to India on the 1st of April 2023 and leaves for Australia on December 23. Determine the residence status of Mr. E and HUF for the assessment year. So we have to determine the residence status of both Mr. E as well as an HUF. Read this.
During the previous year 2023-24, Mr. E has stayed in India for 245 days, that is 30 plus 31 plus 30 plus 31 plus 31 plus 30 plus 31 plus 30 plus 1 days. Therefore, he is a resident. However, since he has come to India after 15 years, he does not satisfy the condition for being ordinary resident. Therefore, the residential status of Mr. E for the previous year 2023-24 is resident but not ordinarily resident.
So, because he is satisfying one of the conditions that he has stayed for more than 182 days in India, so he becomes a resident. But since he has never visited in India in the last 15 years, only in the last previous year he was in India, so he will not be able to meet any of the condition under Rule 6. So that means he is a resident but not ordinary resident. As far as Mr. E is concerned, he will be resident but not ordinary. अच्छा, आगे.
Since since the business of the HUF is transacted from Australia and policy decisions are taken there, it is assumed that the control and management is in Australia, that is, the control and management is wholly outside India. Therefore, the HUF is a non-resident for the previous year 2023-24.
So basically, let's look back here this chart here, and understand. So in this case, if you look at the first, is the control and management of affairs wholly or partly in India? No. Okay, in this case, it was no. So HUF is non-resident. But as far as Karta is concerned, now we don't look at the Karta at all. HUF status is non-resident. Fine. So he is a non-resident. So whatever income he is going to earn abroad, it is not going to be taxed in India. Whatever HUF income is being earned abroad, it is not going to be taxed in India. But as far as Karta is concerned, he may have a different status than the HUF. Okay, so this is what is coming. Is that clear to everyone?
Yes, sir.
Okay. So, yeah, just read this.
Residential status of firms, AOPs and BOIs.
So, this is AOP stands for Association of Persons, BOI means stands for Body of Individuals. Okay.
Okay. Resident. A firm, AOP and BOI would be resident in India if the control and management of its affairs is situated wholly or partly in India. Non-resident. Where the control and management of the affairs is situated wholly outside India, the firm, AOP and BOI would become a non-resident.
So here, the partnership firm, we don't look at the individual partner status like HUF. But in case of firms, if the firm is being controlled outside India, it has become a HUF. If it is controlled from within India, a business partnership firm, it's controlled in India, it's become a resident. Okay. Now we go to the company, the final one. Okay.
Residential status of a company. An Indian company is always resident in India.
So a company which is registered in India under the Companies Act or any other law, it will be always resident. So this law is very clear that all the Indian companies, like we have Tata's, Reliance Industries, Tata Computer, Tata Infosys, all these companies are, resident companies in India.
A foreign company is resident in India only if during the previous year control and management of its affairs is situated wholly in India.
Suppose there is a company which is not registered in India, but entire decision making control is in India, then they will become a non-resident. They will become resident. Otherwise, it will be non-resident.
In other words, a foreign company is treated as non-resident if during the previous year, control and management of its affairs is either wholly or partly situated out of India.
So that means for all the Indian companies, they are resident. All the foreign companies would be mostly non-resident, except if they are controlled wholly or partly. Control management of affairs are situated in India. If the control and affair is situated only in India, then only they will become a non-resident. Okay. So I'm just skipping this. So we are coming now to the final. So we have already done everything. Okay. So there will be some questions we will be doing. But before we understand, we must understand the income. Okay. Read this.
Scope of total income. Residential status and scope of total income. Whether the following incomes are to be included in the total income.
So this is the chart which explains everything. Now I'm just going to read. So I'm going to take over. Scope of total income. Now there are three categories as far as individuals are concerned: resident and ordinary resident but not ordinary resident, and non-resident. Okay. First, income received or deemed to be received in India during the previous year. So, all the assessees, whether you are resident and ROR or RNOR or non-resident. So, any income which is earned in India or which is deemed to be received in India, I'll explain you what does the deemed means. Okay. So, all the income which a person is earning in India, he has to pay tax. irrespective of the resident status of a person. Now, income accruing or arising or deemed to accrue or arise in India, again, if it is, income, whether the income is received or whether the income has just become accrued, okay, in both the cases, all the Indian income will be taxed in India. Okay, so we are going to understand what is deemed. Okay, so the meaning of why it is written deemed. Okay, so what are the deemed incomes? The last one, income accruing or arising outside India during the previous year. So, if you are a resident and not a resident, yes, you're going to be taxed in India, even if such income is not received or brought into India during the previous year. So, whether if you are earning any income abroad, whether you bring that money in India or not, it doesn't make any difference. You have to pay tax on all your income from whatever source you earn. Whether even if you are earning any income abroad and you're not bringing that income in India, you have to pay tax in India. But if you are a non-resident, then you don't have to pay any tax on your income abroad. But the things differ when you are a resident but not on. Yes, but only if such income is derived from a business controlled or in a profession set up in India. Otherwise, no. Suppose, for example, you are a lawyer and you are doing a practice in India and you have gone abroad, for example, and you got $1 lakh for making some service outside. So that income is actually, the business is controlled from India. So even if you are earning any income outside, you have to pay tax for that, money which you have got abroad as a lawyer fee, because you are doing your practice in India. You have established your practice in India. You have just gone there and performing some, consultancy there or appearing in a court there. Like for example, in case of this guy. Salve, who goes, and practices, and appears in international court of law, he gets some income. So even if he is non-resident but not ordinary resident, and suppose he is like that, so he has to still pay tax in India. Okay, but if he is earning, suppose if a person is resident but not ordinary resident, any foreign income will not be taxed in India, just like non-resident. But only that particular income for which the business has been set up in India. Okay, in that case only that part of income will be taxed in India. So that is the only, and we'll do some questions to understand this also. Okay, is that clear? Have you followed it little bit? I know. I mean,
Uh,
of course, when we'll do some questions and understand it, and then we will be able to, have a grip of this. Okay. So now let's understand. What is your income which is deemed to be accrue? Okay, income deemed to be received in India. Can you read this?
Income deemed to be received in India. Section 7. Contribution in excess of 12% of salary to recognized provident fund or interest credited in excess of 9.5% per annum. Annual accreditation to the credit of RPF.
Okay, just hold on. I'm just going to explain the first box. When you start working in companies, there is a provident fund. Have you all know about a provident fund? I mean, of course, your parents would be, if they're working, so they would be talking about a provident fund. It's a retirement benefit scheme where, if you're working in a company and you're drawing a salary, so the employer will, make a contribution from his side, and you have to, as a salary employee, you have to also make a contribution, and that money will be going to the provident fund account, and normally it will be, with a provident fund commissioner or by a trust, run by a company, and it will be given to you only once you retire from the company or you leave the company. Okay, now the employer is giving you some contribution. Okay, like suppose you are making a, drawing a salary of say 1 lakh. Okay, so 12% will be deducted from your salary. How much? 12,000. And 12,000 will be contributed by the employer, and it will go to a provident fund account. Now, the money which is given by the employer, which is 12,000, is totally exempt. It is not considered as an income uh, in your hands. Now, why it is not treated as income? Though the employer is giving you 12,000, it is going to the provident fund account, because you enjoy a benefit under section 10. All contributions by your employers are not subject to any tax. So whatever money which the employer is contributing to Provident Fund is exempt under section 10 of the Income Tax Act. But there is a limit, only up to 12%. But if suppose the employer gives you 15%, contributes 15%, like suppose if you are drawing 1 lakh salary and he contributes 15,000. So the extra 3,000 will become income deemed to be received in India. Though you have not received it, it is going to your provident fund account. So excess of 12% will be considered as a deemed income in your hands. Up to 12%, totally exempt, because the Income Tax Act says that any income earned up to 12% will not be your income, it will be exempt from income tax. Now, Section 10 generally gives you all incomes which are exempt, like agriculture income in India is exempt from tax. So we are going to, touch Section 10 also later on. So there are certain incomes which are not taxed in India. For example, contribution by the employer to the provident fund to the extent of 12%. But anything above 12%, he has to pay tax. So I'm just going to just show you here. For example, let's say, and then tell me what is taxable and what is not taxable. Okay. Suppose your, let's say your salary is 50,000. Okay. Fine. Suppose, there is a provident fund. Provident fund account. So I'm just saying provident fund account. Okay. Have you heard about provident fund? By any this thing from your family, your parents, or anywhere? Okay.
Yes, sir.
Okay. So now,
Yes, sir.
suppose it is 10%. Suppose it is 12%. Okay. I'm just saying 12%. Fine. So, what will happen is, I'm just going to make two more lines here. So this is, employee, and this is employer. Okay. So this is employer's, contribution. Just listen it carefully because it's very important. And this is employer's contribution. Suppose you have just started your service. This is your first month. Okay. Fine. So you have this. And then I talk about interest. Okay. Interest. So there will be two interest. Okay. Suppose interest is say 8%. This is the government decides. So government says that the employer has to pay to 8%. The provident fund will be paying. So now what will do? You multiply this by this. Okay. Suppose this is 50,000 rupees per month. Okay. And this is the month of for example, this is salary. And this is say April. Suppose you started working in the month of April. Fine. And then in the month of May, like this. Okay. Fine. So we can just, do like this. So I'm just doing his entire year. Okay. Suppose you have been drawing the salary of 50,000 rupees per annum, right from April, 2023 till March 2024. Okay. So this was your salary. Okay. So how much salary you got? Let me just make a total. It will be 6 lakhs. Okay. Now the employer is going to contribute 6,000 and employee is also going to contribute 6,000. Employer. Okay. So that means this 6,000 will go to this, and then you are going to get how much from the company? This minus this employee's contribution. So net payable will be this much. You will get this much from the company. Okay. Every month. Suppose there is no other deduction and your salary you will be getting is 44,000. This is your own contribution minus your salary. Fine. So this is net payable to you. This contribution which the employer has contributed will go to the provident fund account. This will not be treated as your income. So this will not be added to your income because under Section 10, you are given an exemption. Now this is 8%. So, you are going to calculate 8% into, 6,000. Okay. And this is for 1 month. Okay. So you are going to divide this by, whole of this by 12. Sorry, this you are going to get for the whole month, whole year. Okay. So this is for like April, you will be going to get for the whole year. Okay. Fine. So this also I'll just put. Right? So this is what you get. Now, suppose the employer decides to make a contribution of say 15% instead of 12. This is the statutory. Up to 12,000, this is totally exempt in your hands. This is not your income. But now, if suppose the employee says that that this contribution is going to be 15%, okay, so you also contribute 15%, I also got contribution 15%. So that means he is contributing. He was supposed to give 6,000, but he's contributing 7,500. This will be your income, which will be considered as deemed income, for which you have to pay tax. Because the income tax says only up to 6,000, there is no tax. But beyond 6,000, whatever employer is contributing, it will be included in your income and you have to pay tax in that very year. Okay. Similarly, if suppose this interest is say 10%, then how much interest was allowed? 9%, isn't it? Let me just go and check. 9.5. Suppose interest was 9.5, okay? 9.5. Okay. So up to this, suppose if you're getting 9.5, okay, this also I'm writing 9.5, okay. So if you're getting 9.5, it's okay. But if you're getting, say, for example, if you're getting, 15%, fine. So then you are exempt only up to 9.5, which is how much? 712. So extra will be again taxed to you. Okay, 712. So which means that 712 इसमें से minus कर दिया हमने, और this will be, you have to pay tax on this. Right. So that means this 1500 and this 413 will be included in your income. So that is what this law says. Of course. So just read this contribution again.
Sir, can you please explain the last part again? I'm not able to understand.
Just first, is that Kajal?
Yes, sir.
Kajal, just read this, what is written in the box.
Contribution in excess of 12% of salary to recognized provident fund or interest credited in excess of 9.5% per annum, annual accretion to the credit of RPF.
So that means every month or annually, there is some money which is going to your provident fund. Okay. So up to 12%, the contribution which you are getting from your employer is exempt. Employer is giving you some money. Okay. Your salary also. Your salary is taxable in your hand. But the employer contribution is not subject to any tax. Because the income tax says that up to 12%, it will be not treated as your income. So this is an exemption benefit given to the salaried people. This is a government, benefit which has been passed on to the people, that if the employer is giving 12% contribution, up to 12%, it's a retirement benefit. So we are not going to ask you to pay tax on that, because you are going to get your money only after when you retire or when you leave the company. So why should you pay tax now for anything which you have not received now? So, government will say, okay, this is totally exempt. You're not going to pay any tax on whatever the employer is contributing. Of course, your own contribution is deduction from your salary. You are paying, a tax on 50,000. Okay, fine. So whatever your contribution, it is already taxed. But the employer contribution is not taxed to you. Is that okay? 12%. Is this clear, Kajal? See, as per Income Tax Act, I'll just show you here. Of course, I will take you to the section 10 later on. So any money which you contribute to the recognized provident fund, okay, that is totally exempt from income tax. But if the employer says, he wants to avoid taxation, suppose he says, if this rule would have not been there, so he would have made this as, 50%, 40%. So he could have saved, you could have saved all your taxes. He would have given you 20,000 rupees, and that will not go to be taxed in the hands of yours. So he could have avoided the tax. So government says that there is a ceiling, only up to 12% the employer can give, and there will be no tax. Okay. But if the employer is contributing 40%, That means 14,000 you have to pay tax. Though you're not getting the money now, but you have to pay tax because employer is trying to reduce your tax liability. An employee, you can always, enter with the employer and say, okay, you contribute 40% to my retirement benefit. I don't have to pay tax because the employee's provident fund contribution from your side is not taxable. So originally it was like that. So the people started the company started taking benefit of that. So, that's why this rule came that up to only 12%, you have to, up to 12%, the employer's contribution will not be taxable in the hands of the employee. Anything beyond that will be taxable in your hands. Is this clear or not? No.
Yes, sir, it's clear.
Okay. So similarly, he can always make a play if he suppose that it's a 12%. Similarly, there is always on the interest also. So he says that okay, I'll give you 15% rate of interest. Okay. So anything which is above 9.5, he has to suppose it is 9.5, then anything above 9.5, suppose it was 12%, 12.5%, then you have to pay tax on 38 also. So it is both affecting your interest income as well as your contribution. So if any interest is given in excess of 9.5% by your employer on the provident fund, then that money also is included in your income tax. You have to pay tax in India. Tax in that very year. So the government of India through income tax has put a cap both in terms of contribution as well as in terms of the interest which the employer is paying to you on the provident fund. Okay, so let's go back to this. So where it is. Okay, so this was there, okay, fine. So this we have done. So let's do some questions, okay, fine, to understand. Let's go to the Excel sheet. Please open the Excel sheet. Open the Excel sheet. Have you opened? Just open this Excel sheet which I have sent you in the morning. If possible, just open this Excel sheet. Who has opened? Have you got it? This Excel sheet with you? Suraksha? Pratishtha? Are you all there?
Yes, sir, we have got the Excel sheet.
Just open this Excel sheet. Okay? So just Kajal, just confirm whether you are able to see this Excel sheet.
Yes, sir. Yes, sir.
Okay. So the question number 2 I am talking about. Okay. Just read this, Kajal.
Yes, sir. Compute the total income in the hands of an individual aged 35 years, being a resident and ordinarily resident but not ordinary resident and non-resident for the annual year 2024-25.
It's not annual year, it is assessment year.
Assessment year, sorry, sir.
Yeah.
Assuming that he has exercised the option of shifting out of the default tax regime provided under section 1115 BAC 1A.
Okay. So this is, of course, assuming that he has exercised the option of shifting, because there are two schemes now. We are going to understand it a little later. So now this is his income. Okay, fine. So income, these are his income. So the income runs into very long list. So this is all the income. Okay, fine. So first is what? Just read this.
Interest on UK development bonds, 50% of interest received in India.
Okay. So, okay, just hold on. So now what we are going to do is we go to the answer number 2. Okay, fine. The answer says computation of the total income for the assessment year 2024, assuming all the scenario. The first is that he is resident and ordinary resident. Second is he is resident but not ordinary resident. Third is non-resident. Okay. So, interest on UK development bonds. So this is basically UK development bonds. 50% of the interest is received in India. So now this is a foreign income. This is a income of United Kingdom. So as a resident, entire income will be taxed in India. Okay, but he is receiving 50%. Suppose he was a resident but not ordinary resident. Only the income which was brought to India is supposed to be taxed in India. In case if he is a resident but not. Similarly, for non-resident Indian, whatever money which he has brought to India will be taxed in India. Whatever income, suppose it was like in case it was nothing was brought in India. Suppose it was that it was zero, for example. Let me say that it was 0%. So he has not brought any money in India. So in that case, this will be zero. Fine. So only whatever money, if he was a resident, then he has to pay tax on whatever income he is earning from anywhere. Any income which is drawing, any foreign income which is earning, okay, if he is non-resident as well as resident, but not, he will not be taxed in India. But the money which is he has brought to in India, okay, he has to pay 5,000 rupees tax. I mean, 5,000 rupees will be included in his tax liability. Okay. How? Let's go back to the this thing chart and see. So just tell me from where it is coming. Income received or deemed to be received in India during the previous year. Yes, yes, yes. Okay. So that means income received. So in this case, whatever is received in India, he has to pay tax. Okay. Fine. So any income which is received in India or deemed to be received in India, he has to pay tax. So that's why he has to pay tax on this income. Is that clear? Is this clear? Interest on UK
Yes,
development
sir.
bond, it is a foreign income. Only the money which he brought in India, 50% he has brought in India. So as a resident, if you are completely resident, ordinary resident, you have to pay tax on everything. But if you are a non-resident or a ordinary not resident, only which the money which you bring in India will be taxable in India. Similarly, income from business. Now let's go to the question number 2 back. Income from a business in Chennai, 50% received in India. Income from a business in Chennai. Now tell me, whether you are a resident, non-ordinary resident or resident, will you be taxed in that case, you will be taxed. Whether you bring money in India or not, doesn't matter. That because this money has been earned in India, so you have to pay tax irrespective of your residential status. Is that okay? The second case is that you are earning the money in from a business in Chennai. So this is money is actually earning in India. Fine. Okay. So when you are earning money from business in India, tax has to be paid irrespective of your residency status. Whether you receive money in India or doesn't receive money in India, all the money is going to England or any other country where you are staying, it doesn't matter. Is this clear?
Yes, sir.
Now, third, short-term capital gain on sale of shares of an Indian company received in London. So this is a short-term capital gain. That means you bought some shares and sold them and you made a profit. Okay. So it is an Indian income. So you're going to pay tax on the entire money. Okay. Like, short-term capital gain, 20,000 rupees. This is the income which you earn in India. Okay. From the Indian source. So you have to pay tax on it. Whether you receive money in England, London account or anywhere, doesn't matter. So whether you are a resident, not ordinary resident, you have to still pay tax. Is that okay?
Yes, sir.
Now, dividend from British company received in London. Now, in this case, if you look at the question here, dividend from a British company received in London. Now, this is a foreign income, isn't it? So only if you are a resident in India, ordinary resident, you have to pay tax. Other SSAs don't have to pay any tax. Okay. So look at here. So in this case, it will be 0, 0. Only if you are resident and ordinary resident, you have to pay tax. Okay. If you are, like suppose I am in India, okay, and I am getting, some money from dividend. I am holding some, shares of the British company shares, and I am getting some dividend, and they were received in London. Okay, in my London account. But I have to pay tax because I am a resident. Okay. But in case, my daughter who is, a resident but not ordinary resident, if she receives any, dividend from any investment in British company, she is not going to pay any tax in India. Similarly, even a non-resident doesn't have to pay any tax. My daughter is a non-resident, so she doesn't have to pay any tax if she earns any income from a company which is in England and which is declaring a dividend there. Is this clear? Is this clear?
Yes, sir.
Okay. Now read this one. Long term. Just read this.
Long-term capital gains on sale of plant at Germany, 50% of gains are received in India.
Okay. Now tell me, long term capital gains on sale of plant at Germany. Is this Indian income or foreign income?
Sir, it is foreign income, but 50% is received in India.
हाँ तो अगर तो आप रेजिडेंट हैं तो यू हैव टू पे टैक्स इवन फॉर 100% ऑफ योर फॉरेन इनकम इजंट इट So
Yes, sir.
as a resident, you're going to pay tax, on the entire 40,000. But whatever 50% you're going to receive in India, so in the case of, if you are a ordinary, so whatever you have received in India, you have to still pay tax. Okay, whatever is the status, whether you are a resident but not resident or non-resident, you have to pay. So any income which is received in India, as a even if you are non-resident, you have to pay tax. So as far as the if you are a resident, it doesn't matter if you are receiving 50% in India or 50% abroad. So because your global income is taxed in India. So is it clear? So a long-term capital gain on sale of plant, it's a foreign income. Okay, as a a resident of India, you have to pay tax for all the money which you have earned. It doesn't matter where you're receiving the money, but the money which you have received in India, for that portion you are going to pay tax if you are a non-resident as well as you're resident but not non-resident. Is that okay?
Yes, sir.
Okay, just understand, because these are all understanding phase. Okay, then we go to the second part, income. Just read this.
Income earned from business in Germany, which is controlled in Delhi, rupees 40,000 is received in India.
Now this is income earned from Germany, but the business is controlled in Delhi. Okay, how much money you have got? 70,000.
70,000.
And how much money you have received in India? 40,000. So now just have a look here. So in this case, resident and non-resident, they are going to receive both 77,000 will be taxable. Only if you are non-resident, only what you have received in India will become taxable. So how? Look at this slide. Read this one. Yes, income accruing or arising outside India during the previous year. Read this. Yes.
Yes, even if such income is not received or brought into India during the previous year. Yes, but only if such income is derived from a business controlled in or profession set up in India. Otherwise, no.
So that
For non.
means if you are a resident but not ordinary resident, if you are earning any income outside India, but it has been set up, the business has been set up, or it has been controlled in India, it will be taxed in India. So otherwise, if you are earning any foreign income, you don't have to pay any tax, even if you are a resident but not ordinary resident. But if you are earning any foreign income, but that foreign income has been controlled from India, okay. So like I gave an example, suppose you are a lawyer, okay, and your status is resident and not ordinary resident. Okay, your status is RNOR, you're a lawyer. Okay. If you earn any money abroad, by giving some consultancy to, a British company, so whatever money you're going to get, you have to pay tax in India. But at the same time, if you are earning some money from England, suppose you're getting dividend from a British company on the shares, you're not going to pay tax on that because that is not controlled from India. Okay, fine. So let's go back and see that. So in this case, if you see if you look at this dividend, this thing, so there was no tax here, 0, 0. But the business which was controlled, income earned from business in Germany, which is controlled in Delhi, so you have to pay tax here. Okay, but for a non-resident, it will not be taxed because in that case it is no straight away. But whatever money you are bringing in India, you have to pay any tax in that 40,000. Is this clear? Have you got the logic?
Yes, sir.
Okay, now let's go back to the other one. Just read this.
Profit from a business in Delhi but managed entirely from London.
Okay, 15,000. So now what will happen? So let's go the 15,000. So profit from business in Delhi, okay, but managed entirely from London. It doesn't matter. It's a profit from business from Delhi, so tax has to be paid by all the SSEs. It's not a foreign income. It's a money which you have earned from Delhi. Of course, the business is controlled from London or USA. Doesn't matter because this is the income which you are earning from Delhi only, okay, from India only. So everybody has to pay tax irrespective whether the business is managed in India or managed in London, because this is the business which you are doing in in Delhi. Okay, fine. So let's go to the third one. Okay, read this.
Income from house property in London deposited in a bank at London, brought to India,
Okay,
computed 50.
okay, 50,000. So this is income from house property in London. So there is you have a property in London, and you have got some income from there. How much? 50,000. So that means if you look at this income from house property, so this is your income, global income. So if you are a resident, an ordinary resident, you have to pay tax. But in case of a resident but not a resident, you don't have to pay any tax, even if it is brought later on. Income from house property in London deposited in a bank at London, later on remitted to India. It doesn't matter when you are, coming to India and you're bringing that money in India and spending here. It doesn't make any difference. But in the year when you earn this money, okay, and you receive the money in bank in London, but you are bringing this money when you are traveling to India, it doesn't changes the status, so you won't have to pay any tax. This is a important thing you must understand. Income from house property in London, deposited in a bank in London. Okay, so you have a this thing, and then you transfer that money to your family account in India from your account. So it will not change the status of the thing. So it is a foreign income which will not be taxed in the hands of both these statuses. But as a resident Indian, you have to pay tax. Okay, fine. Okay, read this.
Interest on debentures in an Indian company received in London,
So interest on debentures
12,000.
of an Indian company received in London. What will happen? This 12,000 will be taxed in all the cases, or only in the resident Indian? All the cases will be taxed. This is interest on debentures in Indian company. So it's an Indian company income. Okay. If you're receiving in London, doesn't matter. You have to pay tax because it's an Indian company income. Is that okay?
Yes, sir.
Okay, so let's just to complete this and we'll just complete the lecture today's. Fees
Fees,
for, read this.
fees for technical services rendered in India but received in London.
Again the same thing, 12,000, 8,000, 8,000 will be also taxable in cases for all the cases. Okay, this is the money which you have, services which are rendered in India but received in London, doesn't matter. Okay, you have to pay tax in India. Okay, then the other one.
Profits from a business in Mumbai managed from London.
So again, this is a profit from Mumbai. So again, 26,000 will be taxed in all the cases, irrespective the business is managed from London. Okay, fine. So then we go to the second one. Yeah.
Income from property situated in Nepal received there,
So
60,000.
16,000.
16,000.
Now 16,000 is basically a property in Nepal. It's a foreign country. Okay. So that means only if you are a resident you have to pay tax. Others cases you don't have to pay any tax, because this is basically a income which is you have earned from Nepal and received there. So you're not going to pay any tax on that. So let's go back. So this is a foreign income. Okay. Then
Past foreign untaxed income brought to India during the previous year.
so this was your income which was not taxed at all, 5,000 rupees. So so this also will not be taxed in India, because this was a previous year income. Okay, previous you brought it during the previous year, but this you have earned in prior years. Okay, so this was already earned, you have already earned that money, in the previous years, so you now don't have to pay any tax. It was just a remittance of money. Okay, this is just a remittance, this is not your income. You are having some money in the bank account and you just shift it to India, so it doesn't become income on that year. If you have some money in your bank account in England and you transfer to India, it doesn't become your income. Whether you have paid the tax on that income in the early years or not, it doesn't make any sense. So there's no income. Okay. Then read further.
Income from agricultural land in Nepal received there and then brought to India.
So, if it is brought to India later on, doesn't make a difference. So, when the agricultural land is in Nepal and is received there, now suppose this agricultural land would have been in India, then of course in India you don't have to pay any tax on agricultural income. But since how much is 18,000? So let's see. So 18,000 income from agricultural land in Nepal received there. So that means only a residential state guy will pay. Non-resident and not only resident doesn't have to pay. Though it was brought to India later on, brought that money in India doesn't make any difference. When it was earned, it was taxed in Nepal only. It was an agricultural income, so you don't have to pay tax in India. Okay, but only if you are a resident, a purely ordinary resident, then you have to pay tax on that. Okay, fine. Then the read further.
Income from profession in Kenya, which was set up in India, received there but spent in India.
So income from profession in Kenya, which was set up in India. So this is a business which you are doing, you're receiving the money in Kenya, but the business has been set up in India. Okay. You have received the money there, but of course later on you brought in India. So let's see what happens. So in this case, you have to pay tax because all your income will be taxed anyway, whatever is the status, you're a resident. Okay. But in case of a resident, but not ordinary resident, because this is a business which was set up in India. Okay. So that's why you're paying tax. But as a non-resident, you don't have to pay any tax because this is the money which you're earning in Kenya. It's a foreign income. In this case also, this is a foreign income, but it has an India connection. It was the business which you have set up in India. Like for example, let's go and just check this again, which qualifies here. Resident but not ordinary. Yes, but only if derived from any business controlled or in possession profession set up in India. So this profession was set up in India. So that's why you're going to be paying tax on that. Yes. Income accruing, yes, it will be going to be taxed. So that is what we are looking at. Okay. Then we go to the last few ones. Okay. Ritik, read one.
Gift received on the occasion of his wedding.
Now,
20,000.
if there is a wedding of a person, his own wedding, then in India, the law says that the gifts on the wedding are totally exempt. You don't have to pay whatever money you're receiving on your wedding as gift. Okay? Fine. Whatever may be the amount, you don't have to pay any tax on that. So, gift received on occasion of wedding will be totally not taxable. Gift received on occasion of the wedding. Now, as per Income Tax Act, under Section 10, which I am going to just share with you later on. So, even if you are receiving any gift on occasion of your marriage, then that money will not be taxed in your hands. Only on the occasion of marriage. Okay. Then further.
Interest on savings bank deposit in State Bank of India, 12,000.
So 12,000 is the Indian income. So it will be, it will be taxed in India. Okay. So 12,000, 12,000, 12,000 tax in all the cases because it's an Indian income. So whatever is your, the status of your status of residential, you have to pay tax in all the cases. Okay. Okay.
Income from a business in Russia, controlled in Russia.
So this is income from business in Russia. Now tell me, this is controlled in Russia. Who is going to pay tax?
Foreign income, only resident will pay tax.
Only resident. Others will not going to pay any tax. Okay, very good. So income, this thing, nobody is going to pay tax. Only the resident who is ordinary resident. Okay, fine. So okay, read further.
Dividend from Reliance Petroleum Limited, an Indian company, 5,000.
Who is going to pay tax? All or none or anyone?
Everyone is going to pay tax.
Everyone is going to pay tax. Absolutely. Everyone is going to pay tax. 5,000, 5,000. Okay. Let's go to the last one. Agricultural land. Yeah.
Agricultural income from a land in Rajasthan, 15,000.
Now, agricultural income in India, okay, which is, the land is situated in India and you're earning an agricultural income, it is totally exempt in India. So, nobody is going to pay tax because agricultural income is again not subject to any tax because of the section 10 subsection 1. This is the first section. Okay, section 10 का पहला section ही कहता है agricultural land पे कोई भी आपको income होगी उस पर कोई भी tax देने की जरूरत नहीं पड़ेगी. Okay, so now we are going to total it up and we have gross total income, which is the sum of everything. Okay, fine. So this is, so that means the income is 3,000. I'm just going to hide this. Oh, sorry. चलो यहीं देख लेते हैं. So gross total income is 3,52,000, 2,18,000 and 2,83,000. Is that okay? Fine. Now there are certain deductions which are available, in India. If you are having a bank account, like there was some money which he got interest from a bank, interest on saving account, State Bank of India. How much money was received from State Bank of India on saving account?
12,000.
Now, if you are earning any interest on the saving account in India, up to 10,000, it is totally exempt. Again, under section 10. आपके बैंक अकाउंट में पैसा पड़ा रहता है, उस पे आपने अगर 10,000 रुपए तक का कोई भी इंटरेस्ट आप अर्न करोगे, उस पे आपको कोई भी टैक्स की छूट मिलती है. So we just go here and interest. Read this less.
Less deduction under section 80 TTA, interest on savings bank account subject to a maximum of rupees 10,000.
Okay, so this is the deduction which is available to you under section 80 TTA. So we are going to do all these sections like 80C, 80D. Oh, there are so many sections there. So one of the section 80 TTA says that interest on saving account subject to a maximum 10,000 will be, so 10,000 will be exempt. So what will be your income? So this much will be your total income. So the gross total income will be this. Okay, and this will be the reduction. This will be your total income. Is this clear? Okay, so now you can just read it yourself, and we are going to complete some of the parts which we have not done, and we'll do some more questions next time like this. Okay, and so we are going to have I'm just going to